Corporate bonds and debt securities. Exploring key features and investment strategies. Agenda items. Overview of corporate bonds. Secured debt securities. Unsecured debt securities. Convertible and exchangeable bonds. Guaranteed bonds. Floating rate notes. Payments in kind notes. Definition and characteristics. Understanding corporate bonds. Corporate bonds represent loans made by investors to corporations, serving as a way for companies to raise capital. Defined maturities and interest rates. Corporate bonds come with specific maturities, interest rates, and terms, providing structured investment opportunities. Earnings from investments. Investors earn interest on corporate bonds until maturity, when they receive their principal investment back. Types of issuers. Large corporations. Large corporations typically issue corporate bonds with higher credit ratings and lower risk profiles, attracting a wide range of investors. Small businesses. Small businesses can also issue bonds, but they generally carry higher risk profiles and may have lower credit ratings compared to larger firms. Government entities. Government entities issue bonds as well, often perceived as lower risk, providing essential funding for public projects and services. Investment considerations. Credit risk. Credit risk refers to the possibility that a bond issuer may default on payments. Evaluating credit ratings is essential for informed investment decisions. Interest rate risk. Interest rate risk is the potential for bond prices to decline as interest rates rise. Understanding this relationship is crucial for bond investors. Market conditions. Market conditions, including economic indicators and investor sentiment, can significantly influence bond performance and investment returns. Secured debt securities. Definition. Secured debt securities are financial instruments backed by collateral, ensuring investors protections in case of default. Role of collateral. The collateral provides a safety net for investors, allowing for asset liquidation if the issuer defaults on payments. Common examples. Mortgage-backed securities are a prominent type of secured debt security that provides regular income based on property mortgages. Fixed charge over assets. Definition of fixed charge. A fixed charge is a type of security interest granted over specific assets. It gives priority to investors during liquidation. Priority in liquidation. In the event of liquidation, fixed charges ensure that investors are paid before other creditors. This enhances their security. Risk assessment. Evaluating fixed charges is critical for assessing bond risk. It helps in determining the overall creditworthiness of the issuer. Floating charge over assets. Definition of floating charge. Floating charge is a type of security interest that allows issuers to use their assets while still securing their financing. Business operations flexibility. Floating charge provides issuers the flexibility to manage their assets in business operations without immediate restrictions. Conversion to fixed charge. If the issuer defaults, the floating charge can convert into a fixed charge on remaining assets, providing added security to lenders. Unsecured debt securities. What are unsecured debt securities? Unsecured debt securities or debentures are financial instruments that do not have collateral backing for repayment. Creditworthiness dependence. These securities rely entirely on the issuer's creditworthiness, making them riskier compared to secured debt instruments. Higher interest rates. To attract investors, unsecured debt securities offer higher interest rates as compensation for the additional risk involved. Risk factors and investor protections. Default risk. Investors face default risk when investing in unsecured debt securities. meaning the issuer may fail to pay interest or principal. Lower recovery rates. In the event of bankruptcy, unsecured debt holders often experience lower recovery rates compared to secured creditors. Investor protections. Investors should seek protections through covenants and credit ratings that can help mitigate risks associated with unsecured debt. Comparison with secured debt securities. Risk factors. Secured debt securities carry higher risks as they are not backed by collateral, making them riskier for investors. Potential returns. Investors must carefully evaluate the potential returns of unsecured debt against the risks involved in their investments. Investment strategy. Choosing between secured and unsecured debt securities requires a thoughtful investment strategy considering risk tolerance. Convertible and exchangeable bonds. Convertible bonds overview. Convertible bonds give investors the option to convert their bonds into shares of the issuing company, offering potential equity growth. Exchangeable bonds explanation. Exchangeable bonds can be converted into shares of a different company, commonly a subsidiary, diversifying investment options. Mechanics of conversion and exchange. Conversion mechanisms. Conversion mechanisms outline the specific terms for converting bonds into equity, detailing the process for investors. Exchange mechanisms. Exchange mechanisms dictate how and when investors can exchange their bonds for equity, impacting investment decisions. Importance for investors. Understanding these mechanisms is crucial for investors to make informed decisions regarding their investments. Investment benefits and risks. Convertible bonds advantages. Convertible bonds provide investors an opportunity for equity participation, combining fixed income with growth potential. Fixed income characteristics. These bonds also offer the stability of fixed income investments, making them attractive for conservative investors. Equity price risks. Investors must be cautious of equity price fluctuations, which can impact the value of convertible bonds. Guaranteed bonds. What are guaranteed bonds? Guaranteed bonds are debt securities backed by a third party, ensuring bondholders receive payments even if the issuer defaults. Role of guarantors. A guarantor, such as a government entity or insurance company, takes responsibility for payment, adding security for bondholders. Examples of guaranteed bonds. Common examples of guaranteed bonds include those issued by government entities and bonds backed by insurance companies. Role of guarantors. Importance of guarantors. Guarantors enhance the perceived safety of bonds, providing assurance to investors regarding repayment. Impact on risk profile. Creditworthiness of a guarantor can significantly alter a bond's risk profile and influence its ratings. Impact on credit risk. Role of guarantors. A guarantor provides assurance to lenders, reducing the perceived risk associated with a bond, especially in uncertain markets. Lower interest rates. The backing of a guarantor often results in lower interest rates for bonds, making them more attractive to investors. Comparison with unsecured bonds. Bonds without a guarantor typically carry higher credit risks, leading to increased costs for issuers and investors. Floating rate notes. Floating rate notes are a type of debt instrument with variable interest payments tied to a benchmark rate like LIBOR. Interest rate variability. Interest payments on floating rate notes fluctuate, providing flexibility compared to fixed rate instruments. Protection against rising rates. Investors in floating rate notes benefit from protection against rising interest rates as payments increase with the benchmark. Interest rate adjustments. Floating rate notes. Floating rate notes have interest rates that are adjusted periodically based on specified reference rates, impacting investor income. Adjustment intervals. Interest rate adjustments occur at predetermined intervals, making it essential for investors to track these dates for income forecasting. Understanding reference rates. Investors must familiarize themselves with reference rates used for adjustments to anticipate changes in their investment income. Market demand and investment strategies. Interest rate trends. Interest rate trends significantly influence market demand for floating rate notes. Fluctuating rates can impact investment decisions. Portfolio strategies. Investors develop strategies to adjust their portfolios in response to changing demand for floating rate notes, seeking to reduce risks. Mitigating risks. Implementing effective strategies helps investors mitigate risks associated with interest rate changes, enhancing portfolio stability. Payment in kind notes. What does PIK mean? Payment in kind notes are financial instruments that allow issuers to pay interest using additional bonds or preferred stock. Cash flow management. These notes assist issuers in managing cash flow during difficult financial times, providing flexibility in financial management. Payment mechanisms. Payment in kind notes. Payment in kind notes require specific terms for interest payments, which can affect cash flow for investors. Understanding terms. Investors should carefully review the terms associated with payment in kind notes to avoid unexpected cash flow issues. Cash flow implications. Understanding the cash flow implications of payment terms is crucial for making informed investment decisions. Advantages and disadvantages. Liquidity for issuers. Payment in kind notes offer liquidity advantages for issuers, enabling them to manage cash flow more effectively. Risks for investors. Investing in payments in kind notes can lead to higher risks, including dilution and uncertainty in cash flow projections. Conclusion. Importance of corporate bonds. Corporate bonds are vital for investors to navigate the fixed income market effectively, providing options for income generation. Types of bonds. Understanding various types of bonds and their characteristics helps investors in making strategic investment decisions. Investment strategies. Employing effective investment strategies with bonds can align investments with specific financial goals and risk tolerance. Thank you.